I want to show you a recent example of how I applied the wave principle to identify significant bottom in the S&P 500 index. The wave patterns and wave relationships were the primary tool I used to identify this low and forecast and move to new highs, which turned out to be accurate. In addition, I keep track of a number of technical indicators, and I'll show some examples of how those can be used to enhance confidence in the wave forecast. In late March of this year, it appeared that a three-wave ABC decline in the S&P was near an end. A guideline of the wave principle is that waves A and C in a correction tend toward equality. That gave us a target of 2739.45 in the S&P. In addition, there was a previous fourth wave low at 2722.27, and a 38% retracement of the prior advance was very close by at 2722.05. A clear wave count and a cluster of targets gave us strong confidence that a market bottom was at hand. The outlook was for a low in that price range and then a move up to new all-time highs. The actual low was 2728.81 in the middle of the support cluster. As you can see, the S&P moved up to new all-time highs in the following weeks. I also want to show a couple of key indicators that I use to help time the market. These charts from June 3rd in our intraday service. The daily sentiment index on the S&P dropped to 12% bullish on May 31st, and that was a sign that there were few people left to turn bearish and sell, and was consistent with the idea that a bottom was near. The volatility index, or VIX, is a gauge of option traders' expectations for future volatility in the index. As the market declines, the VIX normally rises to reflect a concern about an accelerating decline. But when this relationship breaks down, it can be a tip-off of an impending trend change. Here is a chart that shows just such a divergence. The VIX was not making new highs as the market was making new lows. The next chart shows an inverse volatility ETF that makes that relationship easier to visualize. That non-confirmation was another tool that supported the conclusion that the market was near a bottom. This analysis did not require a read on what the Fed was going to do or what the second quarter earnings would show. Instead, I just used the wave patterns and technical indicators to come up with the forecast for subscribers. Fast forward to the current time frame, and it appears that a market peak of 1 degree or another is close at hand, and I'll be focusing on that in the next days ahead.